Hey everyone, welcome back to Corporate Decoder, the place where we find out that even money market funds have a bit of a story to tell. And sometimes that story is about, well, money. Today we're diving into the latest report from T. Rowe Price Government Money Fund Incorporated. It is a bit of a mouthful, but stick with me, because even in a fund that sounds as straightforward as a government money market, there are always numbers that paint a picture of where things stand. So what's the big picture here? This is a report covering the period ending the 30th of November 2025. Think of it as a checkup on how this fund, which aims to keep your money safe and give you a little bit back, has been performing. We're talking about a fund that invests in very safe government-backed things, so we're not expecting any wild roller coasters here. But we will look at the core health of the fund, its performance, and what it's invested in. Let's get straight to the point for many of you. How much did it cost to have your money in this fund? For the investor class of the government money fund, keeping $10,000 here for the past 6 months cost about $17. That's a pretty small amount, and it comes out to 0.33% of your investment. For the I class, it was even less, just $11 or 0.21%. These are surprisingly low costs for managing money, showing that efficiency is a big deal for this fund. Now, for the size of the operation, the total net assets for this fund are a massive $13,884,057,000. That is a lot of money being managed. And how many different things does the fund hold to achieve this? 96 portfolio holdings. That's a decent number, suggesting a diversified approach within its safe investment strategy. So what exactly is this fund investing in? The biggest chunk, 45.7%, is in US government agency repurchase agreements. This effectively means the fund is lending money short-term secured by government assets. It's a very conservative way to earn income. Next up, 37.8% is in US Treasury debt. That's direct lending to the US government, considered one of the safest investments out there. Then 14.9% is in US government agency debt, similar to repurchase agreements, but direct debt issued by government agencies. Finally, a small 1.3% is in US Treasury repurchase agreements, and just 0.3% in something called short term and other investments. It's all about safety and short-term lending here. Let's zoom in on the top holdings. US Treasury bills make up 19.4% and US Treasury notes are 18.5%. These are short to medium-term government debts. Then we see some major financial institutions like Ben Mellon at 16.7%, Federal Home Loan Banks at 7.8%. RBC Dominion Securities at 7.3%, Federal Farm Credit Banks at 5.7%, JP Morgan Chase at 4.0%, Canadian Imperial Bank at 2.9%, Goldman Sachs at 2.7%, and Wells Fargo at 2.1%. These are all part of the repurchase agreements, where these banks are essentially holding government securities as collateral for the fund's cash. It paints a clear picture of a fund focused on the highest quality, shortest term government and agency debt and related transactions. Looking at the financial highlights for the investor class, the net asset value has consistently stayed at $1 per S-share over the years, which is exactly what you'd expect from a stable money market fund. The total return for the 6 months ending the 30th of November 2025 was 1.98%, for the full year ending May 31, 2025. It was 4.56%. These returns are modest, but expected given the fund's conservative strategy. The net expenses are right around those low cost percentages we saw earlier, confirming the fund's efficiency. Now for the I class, the story is similar, but with even lower costs. Their total return for the 6 months ending the 30th of November 2025 was 2.04%, and for the year ending May 31, 2025, it was 4.68%, again very stable and consistent returns. The net expenses are also in line with the low percentages we already discussed, meaning this class is even more cost effective for larger investors. Let's dig into the actual securities. Under US government agency debt, we see a lot of holdings from Federal Farm Credit Banks and Federal Home Loan Banks with various interest rates and maturity dates, mostly in 2026 and 2027. For example, there is a Federal Home Loan Bank's bond maturing in February 2026 with a 3.76% coupon, valued at nearly $200 million. These are all top-tier quality debt instruments. Then we get to the biggest section, US government agency repurchase agreements. This is where the bulk of the fund's assets are sitting. We see agreements with major banks like Bank of America, Bank of Montreal, Ben Mellon, Canadian Imperial Bank, Citigroup, Goldman Sachs, JP Morgan Chase, Royal Bank of Canada, Toronto, Dominion Bank, and Wells Fargo. These agreements are all collateralized by US government securities. For instance, there is a repurchase agreement with Ben Mellon, valued at over $2.3 billion, backed by US government securities. This section highlights the fund's active role in short term lending against the safest collateral. Following that is US Treasury debt, which includes US Treasury bills and notes. We see many different bills and notes with various coupon rates and short maturities, like a US Treasury bill with a 2.817% rate due in December 2025, and another with a 4.093% rate due in December 2025. These are held in large quantities, some in the hundreds of millions of dollars. This is the core of their government money market strategy, directly supporting us government financing. The final investment category is US Treasury Repurchase Agreement, a smaller portion with an agreement with State Street, also collateralized by US government securities. It is a single, fairly large transaction, reinforcing the fund's strategy of using secured lending with the safest possible collateral. Let's look at the overall financial health. The total assets are just under $13.9 billion. Liabilities are relatively small at about $23 million. This results in net assets of nearly $13.9 billion. The net asset value per S-share for both the investor class and the I class remains at a solid $1. This stability is key for a money market fund. In terms of income, for the 6 months ending the 30th of November 2025, the fund generated about $287 million in interest income. Expenses were around $20 million. This leaves a net investment income of about $267 million. They also had a small net realized gain on securities of $93,000. The increase in net assets from operations is also about $267 million. This shows a healthy income generation from its conservative investments. Looking at the changes in net assets, the fund saw a substantial increase of over $1 billion during the period. This increase comes from operations, which generated over $267 million, and from capital share transactions, where more money came in from investors buying shares than was paid out to those selling shares. This growth in assets is a positive sign, indicating investor confidence and consistent performance. The fund operates as an open-end management investment company following us generally accepted accounting principles. They account for investments on a trade date basis for transactions and use accrual accounting for income and expenses. Realized gains and losses are reported on the identified cost basis. This is standard practice for investment funds. This section is important. The fund values its financial instruments at fair value, which is essentially the price they'd get if they sold them in an orderly transaction. For government money market funds, they primarily use amortized cost, which is a method of accounting for the cost of a bond or other debt instrument and spreading it out over its life. They state that all financial instruments on the 30th of November 2025 were classified as Level 2 in the fair value hierarchy. Level 2 means the inputs used to determine fair value are observable, either directly or indirectly, like quoted prices for similar instruments or interest rates. This confirms their investments are valued based on market data, not just internal estimates. Here, they detail their repurchase agreements, explaining that they enter into these with well-established banks and dealers, and crucially, all agreements are fully collateralized by US government or related agency securities. They monitor the collateral daily to ensure its value exceeds the loan amount. While they mitigate risk, they do acknowledge that a counterparty failure could cause a delay in recovering value or a possible loss of income. This is a standard risk disclosure for such transactions. The fund expects to maintain its status as a regulated investment company, which means it distributes most of its taxable income and gains to shareholders. This generally avoids double taxation. They also mentioned that their cost of investments for tax purposes was around $13.8 billion, aligning closely with their reported net assets. This section tells us that T. Rowe Price Associates Incorporated manages the fund, and they charge a management fee of 0.18% of the fund's average net assets. There are also expense limitations in place for both the investor and I classes to keep costs down. Price Associates may voluntarily waive fees or reimburse expenses to ensure a positive net yield. Importantly, for the 6 months ending the 30th of November 2025, there were no voluntary waivers by Price Associates, suggesting the fund was performing well enough on its own. They also detail expenses paid to service providers like T. Rowe Price Services Incorporated for shareholder services. So, what is my take on this filing for the T. Rowe Price Government Money Fund? This is a fund that, as expected, is all about safety and stability. Its investment strategy heavily relies on very short-term government backed securities and repurchase agreements with major financial institutions. The costs are remarkably low, which is a significant plus for investors looking for efficiency. The returns are modest, as they should be for this type of fund, but consistent. The fact that they didn't need any voluntary fee waivers from the management company during this period suggests the fund generated enough income to cover its expenses and provide a positive yield, a healthy sign. The primary risk, as noted, is counterparty risk in repurchase agreements, but this is heavily mitigated by the requirement for full collateralization with US government securities. There are no major red flags here. It's a solid, reliable money market fund delivering on its promise of capital preservation and modest income. Alright, that is our breakdown of the T. Rowe Price Government Money Fund's latest report. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description below. Thanks for watching. See you next time.